Thank you so much, Catherine. Thank you for having me this evening as an expert to speak on mortgage matters. I'll start off just by telling you a little bit about myself. Also, just to kind of preface this, I am having some technical issues today, so I'm working off of my laptop instead of my desktop, so I can't really see things as well as I normally would. So I apologize in advance if this isn't quite as polished as it otherwise would have been. So a little bit about myself. I work for mortgage architects. I have been licensed since 2020. I became a mortgage agent kind of right as COVID was taking off and the world was kind of falling apart. So what better time to start an entirely new career? I work with 57 different lenders. I'm part of an amazing team. Together, we fund over 250 million annually in mortgages. So basically speaking, we help a lot of people with their mortgages on a regular basis. And I came into this field from being an ambulance dispatcher before. It was a really tough position, and I learned a lot about myself. Mostly that I have this innate need to help people and in their time of need. So I really focus on that in my current role as a mortgage agent. My job is solely focused around helping people and doing the very best possible job I can for you. I also I really like to focus on different charitable endeavors, and I run a bunch of different charitable programs throughout the year. I run a fundraiser every February where we raise money to place more defibrillators throughout the community, hoping to save lives. Myself and another broker, we came together to start a charity with children where they get to come out and donate money toward various different causes. They listen to different charities speaking. So those are some things that are near and dear to my heart. I really like helping out in the community as much as I can. So tonight, focusing solely on helping people and knowing that a lot of people are really struggling with finances right now, I thought that covering some different ways that you can use your mortgage to kind of better your financial situation, improve your cash flow. So those are the types of things I'll be talking about tonight. So just kind of high level overview of the agenda. We'll be talking about unlocking the power of refinancing. We'll be exploring second mortgages. We'll talking about the importance of reviewing your options, strategies for financial relief. I'll go over a case study with you of real life clients that I had recently. I'll answer any questions you have in a Q&A, and then I'll wrap it up with a quick conclusion. I'll give you my contact details if you need to reach out to me. One thing I would like to mention about the Q&A, being that I am talking about finances and sometimes we will be talking about confidential things, I would prefer that nobody mentions anything specific to their own financial situation in the Q&A. I'd like to keep it to general questions only. I don't want there to be any identifying information released. So if you do have something specific to yourself that you'd like to talk about, feel free to just leave a note in the chat. I'll reach out to you after, and then we can schedule a one-on-one call where we can talk about that in more detail. All right, so we'll start off by talking about unlocking the power of refinancing. And I'd really just like to start at the basics. Not everybody knows what a refinance is. So refinancing is like giving your existing mortgage a makeover. It involves replacing your current mortgage with a new one, and ideally we want that to be under better terms. So you might be wondering why someone would even consider doing that. One compelling reason is that we can secure you a better interest rate, and especially now in the current rate environment where we are, rates have been extremely high. They've been rising for a very long time. However, they are starting to come down. So it's very important that you don't just take the first offer thrown at you, and you really make sure that you have someone watching out for your best interest, keeping an eye on whether or not rates are dropping, and making sure that they're getting you the best possible interest rate. Interest rates do fluctuate over time, and if you did originally lock in your mortgage at a higher rate, refinancing can enable you to take advantage of lower rates that are available in the market. This could potentially involve penalties, so it is something to be mindful of, and we would talk about that in detail during an initial consultation if I thought that might be applicable. However, this can potentially save you a substantial amount of money over the life of your mortgage. And in today's market, I see this mostly with clients that were previously with an alternative lender, and now they're reaching maturity and they're not really sure what they should be doing, whether they should take the offer that the alternative lender is giving them, or if they qualify to be moved over to the prime side. So our goal is to refinance their mortgage and move them over to a prime lender so that they can get a lower rate than what the alternative lender is offering them. Another fantastic use of refinancing is debt consolidation. If you have multiple high interest debts, such as credit cards, personal loans, lines of credit, even some car loans can have a significant interest rate attached to them. Refinancing can allow you to access your equity and roll all of these debts into your mortgage. And by doing this, and combining all of your debts, you're putting them all into one manageable monthly payment, which with most likely a lower interest rate than what you're paying on any of those products, and overall reducing your monthly financial burden. So this really helps with cash flow. And this is something that I am doing day in and day out with clients right now. With the cost of living having skyrocketed, interest rates are as high as they are. This is a really valuable tool to help people stay in their homes, not have to sell them, use a bit of their equity that they've earned over the years that's built up, and it just helps them stay afloat until rates come back down and the economy stabilizes a bit more. Also, with refinancing, we have the option of extending your amortization or the life of your mortgage as far out as 30 years on the A side or the prime side, and as far as 35 years in the alternative lending space, which, although you are increasing the overall interest paid, this can significantly reduce your monthly payments. And this can make it much more manageable for your budget. So in summary, refinancing is a very powerful tool that can help you secure a better interest rate on your mortgage. It can help you consolidate high interest debts, and it can help you lower your monthly payments. Next, we'll be exploring second mortgages, which is another way that you can access your equity. A second mortgage is another financial strategy that can help you unlock the potential of your home's equity for important expenses. So first, I want to clarify what a second mortgage is. A second mortgage is an additional loan that you take out against your home on top of your primary mortgage. So you're going to have your first place mortgage, and then a second mortgage would go on title after that. What makes it valuable is that it allows you to tap into the equity that you've built into your home over time without interfering with your primary mortgage. So this is particularly helpful where if you did a refinance or a renewal back in 2021 when rates were super low, you still have a couple years left on your term, you don't want to break that, pay a penalty, but you really do need to access your equity. A second mortgage is a really great option to look at so that you can use your equity. Perhaps you can consolidate debt, or maybe if you have kids going off to kids going off to school, you could help with tuition, or if you had renovations you needed to do, you could use a second mortgage to help fund all of those things without interfering with your first mortgage. However, I do want to make a point of mentioning that it is extremely important that whoever is helping you with your mortgage knows whether or not your first place mortgage allows, whoever the lender is, allows for second mortgages to go on title or be registered on title. Some lenders do not allow this at all. Some lenders, it depends on how they've registered the mortgage, and they could issue a demand letter if they find out you have a second mortgage. So it's extremely important that the person you're working with is knowledgeable about this topic and knowledgeable about different lender policies, and also make sure to double check that information before any of this takes place. So just to explore some of the benefits, again, this allows you to access your equity. And one of the primary advantages is it lets you do this, again, without touching your first mortgage. It stays in place. You're not paying a penalty to do that. it does still carry a lower interest rate than most main credit products, like again, credit cards, loans, lines of credit. They still tend to have higher interest rates than second mortgages do. I do have a lender currently offering second mortgages even lower than first place mortgages at 4.99%. So it is a very lucrative offer. That lender is very specific to certain client types. So not everybody qualifies for it, but it is definitely an option that's there. This can be used to pay, again, for even car loans or student expenses, medical expenses, unexpected emergencies. You can use that money for anything you need. The key question here, though, is what is the exit strategy? So second mortgages differ from first place mortgages because you don't want to stay in it forever. Of course, a first place mortgage you don't want to stay in forever either, but that is more long term. Second mortgages, the idea is we're putting you into this as almost a band-aid solution. The idea is to have an exit strategy in place so that you're not in it long term, because it does carry a higher interest rate typically, unless you qualify for that special product. It does carry a higher interest rate than most initial mortgages or first place mortgages. So what we typically look at is aligning your maturity dates. So what that means is when your second mortgage comes up for renewal, ideally the date is the same as when your first place mortgage comes up for renewal. So what we could then look at is a refinance, which allows you to bundle both together, and then the second mortgage is paid off and you don't have to think about it any longer. So in conclusion, second mortgages, they are versatile and they are a valuable financial tool that allows you to access your home's equity for important expenses. They come with benefits like access to equity, lower interest rates, and it does make it an attractive option for various different financial needs. Next, I'll be talking about the importance of reviewing your options. Let's start with a common scenario, and I'm getting a lot of calls about this specifically right now. So your mortgage term is coming to an end, your lender sends you a renewal offer, and it is super easy to think that just sticking with the same lender and taking whatever term they offer you is the simplest path forward. And you'd be absolutely correct in that it is the simplest path forward, but it is not necessarily the most financially savvy move. And it's not necessarily the most efficient use of your money. So you may have encountered this before. If you've been a homeowner for a long time, most people actually just take a 5-year fix, whatever their lender is offering them, they just take it, sign it, that's it. However, in the rate market that we're in right now, where rates were really high for a long time, now they're starting to come down, it's really important to review those options. Renewal offers don't always reflect the most competitive rates available in the market, and by not exploring other options, you could be missing out on substantial savings. So I'm going to give you a really quick real-life scenario here. One of my current clients received a renewal offer from her current lender for 6.59% on a 3-year term with a 25-year amortization. I collected all of her documents and did a thorough review of her finances and saw that she had multiple different accounts with a different lender. So I submitted her file to that lender and I requested a rate exception given that she has multiple different products with them. And I was able to get her 5.94% on a 3-year term and a 25-year amortization, where the lender will allow me to even request lower rates for the client should rates continue to drop. And I can do that right up until 3 days before closing. She doesn't close until mid-January. So at this point, rates could drop even another 0.25% by then. No one really knows. So it's nice to have that flexibility. Whereas if she had just signed on the dotted line with the offer her lender gave her, she would have had a significantly higher interest rate and no ability to request a lower rate if they were to keep dropping right up until maturity. So I actually did the math so that I could put this into perspective. The difference in her monthly payment between the 6.59 and the 5.94 is $147 a month, which, depending on your finances, may or may not seem that significant. But if we do the math over her 3-year term, that's an extra $7,582 she's not spending on her mortgage. Plus, she will have paid an additional $1,959 onto her principal. So, sorry, she was saving $5,292 on her monthly payments. Her interest that she saved was $7,582, and then she's paying off an extra $1,959 on her balance. She's saving a ton of money. She could even take the extra money that she's not making onto her mortgage payments and actually just drop them onto her mortgage anyway and pay it off even faster. She has that option if she wanted to increase her payments, or if she wanted to save it and make a lump sum payment, she could do that. Or she can just leave it as it is and use that money for something else, whether she wants to put it into savings or if she wants to invest it somewhere, she has those options. So when you take the time to review your options, you're opening the door to potential savings. And by shopping around and considering different lenders, you can often find better interest rates and terms. Even a small reduction in your interest rate can translate into significant savings over the life of your mortgage. It's like finding a sale on something that you use every day. And also, I want to point out, more often than not, when someone's cell phone plan comes up and it's ended, they qualify for a new phone, they're not just going to take the very first offer. They're going to call around to the different phone providers and see what they can offer. Why would you not do the same thing for your mortgage? However, that's where a mortgage broker or a mortgage agent comes into play, because we can access 57 different ones all in one shot. You don't have to do the calling around. You call one person and you get the answer for all of the different lenders. So ultimately, it's about empowerment through knowledge. And when you're informed about the mortgage market and you understand your options, you're in a position to make confident, informed decisions that align with your financial goals. After all, it is your financial future. So next, I will take a quick minute. We'll talk about strategies for financial relief, and then I'll show you a case study where I actually did a refinance for someone, compared it with their renewal offer. So strategies for financial relief. Life can be unpredictable, as we know, and as we've all seen recently. And sometimes we need to adapt our mortgage to better align with our current financial situation. So here's some effective strategies to provide homeowners with financial relief. So again, you can extend your amortization anywhere from 30 to 35 years, and that automatically lowers your payments. One way to relieve immediate financial pressure is by extending the amortization period of the mortgage. And that's just the overall length of time it takes you to pay off your mortgage in full. By extending it to 30 or 35 years, you can lower your monthly mortgage payments. And this can be especially helpful when you're going through a period of reduced income, or if you're facing unexpected expenses. You also have the option to adjust your payment frequency to better suit your budget. Another effective strategy is, again, reducing your payment frequency. You can adjust it. You can consider switching from biweekly accelerated, or you could switch that to a regular biweekly payment schedule, or even a monthly payment schedule, depending on what suits your budget. And this can help you better manage your cash flow and reduce the financial strain during any uncertain times. You do also have the option of switching to a new lender for a more competitive interest rate. Don't forget the power of competition. Switching to a new lender can often lead to a more competitive interest rate, potentially saving you a significant amount over the life of your mortgage. Again, it's like shopping around for the best deal, and it's a strategy worth exploring when your mortgage term is up for renewal. Remember, there is no one-size-fits-all solution, and the key is to tailor these strategies to your specific financial situation. So now this is my favorite part of the presentation, because this is where I'm going to show you an example of a debt consolidation that I did for some clients of mine. This was about a month ago now, and in this example, I've changed their names, I've changed the creditors, but otherwise all of the numbers remain the same, so that I could give you a true representation of what this could look like. So this was their current situation. We'll call them Sam and Jessica, and when they came to me, they were having cash flow issues and they were in a panic. They were contemplating selling their house because they couldn't see how they were going to be able to continue affording their home. They were barely getting by with their current scenario, and they were reaching mortgage maturity. So as you can see in my chart here, they're spending a fairly significant amount of their monthly income on additional debts. So if you'll take note of the chart here, they had a mortgage balance of $350,000. They had a great rate of 2.59. Their monthly payment was $1,583. On their additional debts, they had a Visa, a line of credit, a car, $450 payment, a $900 payment, a $698 payment. All in all, mortgage plus debts, they were paying $3,631. I did the mortgage figures in all of these scenarios are estimates based on a 25-year amortization and a 5-year term. And then their debt payments are based on 3% monthly repayment. So like I said, they were spending a fairly significant amount, but they were just getting by as it was. Now, this is what their bank offered them. So their bank reached out with an offer. They were going to see a payment increase of over $600. Now, I don't know about you, but I personally couldn't afford a $600 increase just just on my regular expenses. Everything else has increased in price as well. Like we're talking gas, groceries, everything is more expensive than it used to be. And now tacking on an extra $600 a month, I don't know many people that could manage that easily. So they were still going to be looking at keeping their mortgage balance the same at 350. The rate they were being offered was 6.09. Their monthly payment was going to jump to 2258. Then they still had their visa, their line of credit, their car. All of those amounts were still outstanding and they were still paying them monthly. Something else to keep in mind with lines of credit, usually those are interest only payments. So you're not actually even making a dent on them more often than not. So their monthly payments were going to increase to $4,306. They were considering selling their house. They had no idea how they were going to afford this. So I collected all their documents. We had a call, a lengthy conversation about what was going on and what I thought I could do. I collected their documents and I kind of put everything together to see what we could figure out for them. So I suggested that we increase their balance to $455,000. I could get them the same rate that they were being offered by their bank, 6.09, but I was allowing them the ability to get equity out of their house to pay off those debts. So their monthly payment would increase to $2,732, but in that, we have paid off their visa, their line of credit, their car, and I was also able to get an extra $13,000 for them to go into an emergency savings account so that if anything unexpected happened, they had any other costs that came up, an emergency or anything, they had money set aside for it. They didn't have to worry about using credit again for it. By doing this, I'm saving them just shy of $900 a month, $899. Can you that's a huge amount of money to be saving on something this manageable. All we did, we took out a bit of extra equity. We paid off the debts they had, gave them a savings account. I extended their amortization from 25 years to 30. And this was just based on a 5-year term. Don't have to take a 5-year. You could look at a 2 or a 3-year term, which is actually advisable based on the way the market is going right now. But this was what they were comfortable with. They didn't want to have to think about it again. So we went with the 5-year term for them. So they were saving a substantial amount of money. Something else that I did for them was I connected them with one of the financial planners that I work with. She's excellent. I recommended her. They connected. And now they are able to look at options of taking that $900 a month that they're saving and either putting it into investments or continuing to save it. I'm not sure what they did on that side, but when I did make the recommendation for them because I feel like it's important that they have a plan going forward for all of the extra money that they now have on a monthly basis. So I will quickly talk about the steps that we would take to get started. And it's really quite easy. All you need to do is book a discovery call with me, or you can even just send me a message or an email and I can help you book that call. Usually it lasts anywhere from 30 to 45 minutes. We do like a full deep dive into your finances. I ask 1,000,001 questions so I can get a really good understanding of your overall financial picture. I ask about income for anybody that's on title or anybody that's living in the house. I ask about credit history, your score, if there's been any challenges. I talk about like your actual payment history to make sure that you haven't been missing mortgage payments. And if you have, we come up with a plan for that. We talk about your goals, both now and in future, what you want to see accomplished with this. We really do a deep dive so I can make sure that I have all the information that I need to make a really good recommendation for you. Then what we do after the discovery call, if you feel like you want to move forward, I then send you a link to an online application and it comes from my secure online portal. When I get the application back from you, I send a follow-up email with a link to a whole list of documents that I'll require to work on your file. When I get a full document package back from you, I review your entire file. I put everything together into a report for you. And then we schedule a strategy call where we discuss all the different options that are available to you. I will make my personal recommendation as to which one I think makes the most sense based on all the things we've talked about. And then you let me know how you want to proceed from there. It's super simple. I like to keep the process nice and easy. I don't want to make it any more stressful than is needed, especially if you're coming from a really like cash flow strap position and you're already stressed about how you're going to be paying your bills. You don't need this added stress on top of it. So I do try to make it as easy and seamless as possible. Okay, so that has been an awful lot of me talking and giving you tons of information. If anyone has any questions, again, I ask that you try to keep them as general as possible, no identifying information.